receivables or cover payroll during a slow month or pay for materials before money from your client hits your account, this video is for you. I'm going to show you guys how to obtain a true revolving business line of credit. This isn't one of those MCAs where you borrow 100 and you end up paying back 150,000 or something absorbent like a 45 or 50% interest rate. It's real access to capital you can use when and if you need it. You only pay interest on the amount money that you actually use. The difference between having a line of credit and not having a line of credit in a lot of scenarios is truly the difference between scaling and not scaling for most businesses. We do this every single day in almost every single industry out there, and we've helped a lot of business owners obtain a true line of credit and stay away from these crazy high interest merchant cash advances. The problem that most people have is that good capital is hard to find. Most business owners run into one of the following problems when they're trying to essentially secure good, affordable cash. And the number one problem I see is banks just don't lend. This is true. Banks are depository institutions. Nowadays, banks barely even write SBA loans. Banks used to lend, and now banks don't really lend anymore. Even if you have, spotless credit, great profitable tax returns, they oftentimes only lend to like that middle market, that 25 million in annual revenue and up. What about all the other businesses not doing $25 million? It's tough to get a line of credit from your bank. So that's the big reason is a big issue is banks don't lend. What's left is you guys trying to navigate the commercial credit market. You're trying to deal with all these brokers and these lenders and these high interest loans and trying to navigate what's real and what's fake. So it's another very big problem. And the third biggest issue is most businesses wait too long. A lot of businesses only look for capital when they actually need capital, when they have a dip in revenue. And that's not the best time to do it. It's best to look for cash when you don't need it, when your revenue's up, when your utilization's down, when you're in a good position financially, when you don't need access to capital because you have it. That's when you start looking for capital because you'll qualify for the best terms that you possibly could. It's like giving yourself the best chance. You don't want to run the marathon when you're weak and tired. You want to run the marathon when you're fully energized and full of carbs. So here's the solution. We have a line of credit that's based on revenue. If traditional banks are locked doors, revenue-based financing is the side entrance that most businesses never knew existed. You don't have to submit all your tax returns and go absolutely crazy qualifying for a SBA loan that takes 180 days to qualify for. You can slip in through the side using revenue-based financing, and it's really a game changer for most businesses that are looking for a line of credit. And here's how it works. So instead of judging you just based on your credit score, your credit score is most likely, if you're a business owner, in the 600s. What we look at, which is not bad at all, but what we do is we don't judge you on your credit score. We know you're using your credit to scale. So we look at revenue. So if your business brings in consistent revenue, even just $25,000 to $30,000 a month, you could absolutely qualify. You don't need perfect credit. You don't need a huge time in business, meaning, 5-6 years in business. You don't need a business plan or like spotless taxes where you're profitable. Side note, if you have a good CPA, you shouldn't be profitable. It means you're going to pay taxes. So most businesses aren't for that reason. What you need is you just need to be operating. You need to be operating and collecting consistent revenue. So as business grows, you and your credit line can essentially, your credit line can grow with your company. It just gives you more firepower without without having to start over. The approval process is faster, lighter on documentation, and built for real-world business owners, not paper-perfect applicants. And that's really an important part to note here. Our approval process for a line of credit, it's not unrealistic. It's not, 4 years tax returns, audited financials. It's not all this stuff. It's a very streamlined and simple process because in the real world, business owners are running your business. You're not sitting there doing admin work all day, making sure your financial documents are in order. You're running your restaurant, you're running your manufacturing facility, you're building, you're running your construction company, you're doing other things. So here's how it works. A revenue-based line of credit is a better option, which gives you flexible access to funds. You can draw from whenever you need them. So you don't have to take all the money at once and start making a high monthly payment. You can use the money as you need it. 25 here, 15,000 here, 10,000 here. You can draw the money as you need it and pay it back. So think of a line of credit kind of like a credit card, but with much higher limits, not rates, limits, meaning, your line of credit limit, 50, 100, 200, 500,000, $1 million. So think of it like a credit card, but with much higher limits and better rates and terms. Draw what you need when you need it with a line of credit. You're only going to pay interest on what you use. You can reuse it as you repay it. And the available cash will refresh. So what does that mean? That means if you have a line of credit limit of $100,000, you take $25,000, you can come back the same day, the next day, whenever you want, and pull, the other $75,000 whenever you need it. You have a limit and you can draw as many times as you need up to that limit. And as you pay back, so, if you have a line of credit for $100,000, you borrow $50,000. As you slowly pay back that $50,000, more of that line of credit becomes accessible to you again. So there's no fixed monthly payments, just flexible weekly payments, very flexible. So that the payments based on what you're borrowing. Works for contractors, cafes, salons, shops, retail locations, healthcare companies. It works for virtually all industries. A line of credit works across the board. It's simple, it's fast, and it keeps your business moving without locking you in to a high interest loan that you might not even need. Let's say you're approved for $120,000 and you only need $25,000 this month. Totally fine. You draw it, you only pay on the $25,000. And if you need more later, you just log back into your portal and draw additional cash. No problem whatsoever. So how does this stack up against other loan products? Because there's other loan products out there than just lines of credit. Let's take a look. There's merchant cash advances, there's business credit cards, and there's factoring. So looking at how this lines up against the merchant cash advance, merchant cash advances are fast money, but very steep paybacks. So this is the go-to product for when brokers are pitching you. All these kids from New York City and Brooklyn, they all pitch merchant cash advances. And why? Because merchant cash advances pay the biggest commissions to brokers. At Niche Capital, guys, that's not our goal. Our goal is not spread on acquisition. Our goal is to acquire clients, show them what we can do, and we know it's likely that you'll come back for another loan later. So that's why we offer lines of credit. Because why? It's a good product that you can actually use and depend on. So let's take a look at this MCA. Like, this is the go-to product for brokers, as I stated, and this is how they work. You get a lump sum fast, paybacks start right away. Payments are made daily oftentimes. There's no flexibility or reusability. That means with an MCA, if you pay back, say you borrow $50,000 and you pay them back $30,000, you can't redraw the $30,000. Not at all. Like, it's a fixed product. And oftentimes merchant cash advances can be very expensive. They're oftentimes going to cost more than 30% annual interest. Most of the time it's going to be 40% plus in today's day and age. Let me give an example. With your average across the board merchant cash advance, you're gonna say you borrow $100,000, you're gonna owe them $130,000, meaning you're gonna sign a contract that says you have to pay them back $130,000. And oftentimes there's very little prepayment discounts, meaning you owe them $130,000. There's no wiggle room. Credit cards, personal risk, not built for businesses. So everybody's always talking about a business credit card. Business credit cards still report to your personal credit, and utilization is the number one killer of personal credit. When your utilization goes over 30%, even with the business credit card, your FICO score will drop. That is a big reason. If you're making all your payments on time, you're thinking, well, why is my FICO not in the 700s? You most likely have a high utilization. The last product I want to talk about is factoring. The problem with factoring, and this is why I put this on here, this presentation here, is you lose control of your cash. Factoring sounds like a fixed to cash flow, but it's extremely expensive. Lenders will advance you 80% of your invoice. Then what they do is they collect the money directly from the client, that they now own the rights to the invoice. So lender will advance you 80% of your invoice. The lender owns the invoice. And then when they collect the money from your client, they'll pay you the remainder of the money minus like 6%. Think about it like this. What's more expensive? Paying 6% of what you have in accounts receivable right now, or paying 1, 2, 3% on the money that you'll need? Your invoices can be upwards of 60, 70, hundreds of thousands of dollars. That's factoring is essentially giving 4 to 6% off your gross revenue. That is insane. You'd much rather pay a few points in interest on the money that you need to either start a new job, buy inventory, things like that. It's much more cost effective. And because of that, it makes factoring really expensive. Now, when you break this down, this line of credit, a revenue-based line of credit particularly, it gives you flexibility and control with a few trade-offs. So you draw when you want, you repay as you go, which we've covered. You only pay interest on what you use. Credit replenishes automatically. When you pay it down, the capital you have accessible to you increases. There's no interference with your customers. Just like we talked about with factoring, you have to have your customers fill out a bunch of forms in order to get factoring set up. I mean, it's a mess. And also with revenue-based line of credit, it doesn't hit your personal credit. So this is like the biggest and a really important aspect of a business line of credit. It does not count as utilization towards your personal credit. And of course, it can grow as your business grows. So as your revenue increases, we set up these lines of credit so that they'll also increase with your company's revenue. So if you use it smart, you repay it fast, you can leverage money as low as 5%, unsecured, which is unheard of. Here's a couple real world examples. Let's say your business lands a big project that requires upfront inventory or payroll coverage. So materials, wherever the situation is. You take the job, you need $40,000. So the job's going to earn you, say, $120,000, but you don't get paid for 60 days. Well, you don't want to drain the reserves you have, and you don't want to go the factoring route because you have to give them 6% of the invoice, $120,000. So what you do is you just finance it, And with a line of credit, you draw $40,000. You use it for 60. You use it when your receivable comes in for $120,000. You pay it off, and all you end up paying is like $1,200 in total interest. Now, compare that to an MCA. With an MCA, you need 40 grand. You take 40 grand, you owe them 55, really more like 60 over 24 weeks. You end up paying them back $15,000. With factoring, you end up paying them $5,000 in cost of capital. And with credit cards, it can be even worse. So, when you really line up a revenue-based line of credit amongst these other products, what do you want to do? Do you want to pay $15,000 in cost of capital? Do you want to pay $5,000? Or would you rather pay like $1,200 to borrow $40,000? See, and this is exactly what we're speaking about here. This is why a line of credit is oftentimes, not always, but for the most part, it's a really good option across the board. Let's talk about how much you guys can qualify for and what the rates are. Now, keep in mind, every business is different, but how much can you get? Well, most approved businesses qualify for anywhere from 100 to 150% of your average monthly revenue. So if you're doing $30,000 a month, you might be approved for $30,000 to $45,000, and in some cases even more. The industry is good. If you've been around a long time, you have a strong financial profile. We've seen lines of credit go from $500,000 even up to $1 million. So we typically max out at about $2.5 million in line of credit. But if you're a big business doing a lot of money, no problem. We'll be able to secure something bigger for you. But that's a fair statement to make. What you're going to qualify for, 150% of your average monthly revenue. As far as rates, most credit lines fall between 1.5% and 3% per month. So you're basically looking at like mid-teens annually. The lowest we ever see is about 13% annually. So keep in mind, you're only charged on what you used, and you can repay this early with no prepayment penalty. So if you use it smart, your effective cost of capital can stay in the single digits. Again, compare this to an MCA where you're going to pay 30% no matter what. Compare this to a credit card where you're going to tank your credit by utilizing it. Or compare this to factoring where you're going to pay 4, 5, 6% on your gross top line revenue. It's a much better option to pay a couple points interest. For instance, in this example, if you had a 1.5% interest rate and you borrow this for 3 months, okay, all you're going to be looking at in terms of percentage of money that, your cost of capital is 4.5%. That is extremely cheap when you look at the landscape of the current commercial lending market, like merchant cash advances, like crazy expensive credit cards at 30, 40% APR, and factoring. So a line of credit puts you in control. Borrow what you need when you need it, pay it off, repay it fast, and your effective cost of capital can be very low, like we just discussed, in the single digits. It's one of the cheapest and smartest tools in your business toolkit when you use it right. So by this point, I'd be shocked if you guys weren't, a little intrigued on how to get one. So here's how you guys can get one. So if a line of credit sounds good and sounds like something that, would fit for what you guys are trying to do, here's your next steps. Fill out a short online questionnaire, book a call with me. I'm the person you'll be speaking with. And if it looks like a fit, I'm going to ask for the last 6 months bank statements, maybe a few other things if you're certain industry type. But for the most part, I'm just going to be looking at the last 6 months bank statements. And then I can give you some options. Here's a couple important things to remember about applying for a line of credit. 1, no obligations. 2, 0 hard credit pulls. No spam follow-ups. We're not selling your information or giving it to a bunch of different people. Nothing like that at all. Just good, clean, honest, transparent terms that we can review together, and you can, pick my brain and ask me all the questions you guys have. I like to make sure everything's transparent and you understand everything. So, if you guys like this and then you want to move forward, it takes 1 to 2 days to get the line of credit set up. And if not, there's no pressure. There's no high pressure sales tactics trying to get you to take a line of credit. It's up to you. I do my job. I get you approved for a line of credit. And if you like it, we can get you all set up. It's very simple. We do this for business owners every single day. Okay. I've been doing this for going on 11 years at this point, and we founded Niche Capital in 2020. We actually founded Niche Capital because we got sick of working for these big lenders that just don't care about people. So we've been doing this for a long time. And, as far as the line of credit is concerned, it's one of the best tools you can have at the ready. It's not even so much as having capital, it's having a peace of mind knowing you have access to capital if and when you need it. You can check out real testimonials from real businesses who trusted us to get them a line of credit. And again, guys, these are real businesses. This is Mark Spagnola. He owns Nola's Osteria in New Jersey. He's a real business. A lot of times people will say, "Oh, I have testimonials." From who? Because I see a bunch of fake, stock images of business owners. Guys, these are real business owners, and I'm really proud to show you this. This is Lee. He owns a wedding venue. This is Trevor. He owns a construction company in Arizona. This is John. This is how, if you're in New York on the East Coast, this gentleman's how you get your avocados. He owns M&H Trucking. So take a look at our testimonials. We've done really good for a lot of people because we pride ourselves on one key pillar, and that is transparency and honesty in lending. Thanks, guys, for watching. Hope to talk to you soon.